Just how much damage does tax do each year on your investment accounts? That's what we're going to cover this time on our Income Tax Bootcamp. Thanks for tuning in. Hi, and welcome back to the next installation of our Income Tax Bootcamp on our Ayers Rock Planning channel here. Please give us a moment to give us a like, a subscribe. That will really help us build our channel here in its early days. If you feel I'm giving you value, which I think I'm doing, give me that little reward. It would mean a lot to me. I'd eternally appreciate it. And participate. Get in the comments. Give me feedback. What do you like? What don't you like? Today, what are we covering? We're going to talk about and go through, visualize, how many different ways can I phrase it? The impact that tax has on your regular old post-tax investment account. A lot of people understand, especially this time of year when they start to get those 1099 divs or 1099 inks or interest 1099s, that they pay tax each year on some capital gains within their regular old post-tax investment account that doesn't exist with IRAs or Roth IRAs. And what I want to do is tell you a little bit of a story and then use that story to illustrate the impact that has, because it's tremendous. It's more than you'd ever think. So let's get after it. That's enough of an intro. So go into my screen here. You can see, fan of Excel, I've given these columns here: day 0 to 30, balance. What the heck's it doing there? Depending on your background and growing up in a few different cultures, frankly, a few different religions, there's a parable about a grain of rice. And I won't take you through the whole story, but the Cliff Notes version is that there's a food shortage. So the emperor, or whoever it is, hoards all the grain for public safety. And a girl comes upon a leak of the grains and gets arrested for trying to steal it. But she says, no, I was giving it back. Emperor likes her honesty and her forthrightness. So he says, I'll give you everything you want. And she says, just give me 1 grain of rice each day and for the next month, but double it every day. And he thinks, oh, that's fine, you fool. Let's do what you want. After 30 days, because of the power of compounding, she has all the grain in the kingdom and no longer hoards it and distributes it to people that are hungry. That's the parable. So on this screen here, that's what we're showing is how many grains of rice did this girl have? See, day 1, she gets 1, it doubles to 2, 4, 8, 16, 32. But you can see at the end, she has 500 million grains of rice. But you can see the power of compounding and 100% return. If you were able to double your money from $1 every day, you'd be a millionaire in 3 weeks. It's amazing, right? Of course, when it comes to money, nobody's getting 100% return every day for 21 days in a row. But the power of that grain of rice story is meant to teach the power of compounding. And let's see what that looks like. I put some charts together, visual learners, right? Look at this chart. Here's how many grains of rice she has on the y-axis here and the days. And because of the scale of this thing, you can see it shoots up right at the end. This is where her real wealth in rice really accumulates. And this is true for most people, even if they're not doubling it, by the way. You are accumulating most of your wealth at the very end. That's when the compounding really takes force. And there's a few different videos that we can do on the power of compounding, including the power of compounding loss. But this is the power of negative compounding of taxes in this Income Tax Bootcamp. And this is a good point for me to mention, by the way, that we have my Death and Taxes podcast. I have a companion Income Tax Bootcamp going at the same time. We cover similar topics, but not the same. So if you really want both, I would go listen to that podcast. I give some good information on different topics that are better for audio format there. So let's see. Next question I want to kind of ask. Okay, now what if she had to pay tax on this rice? What would happen? So you can see, and instead of rice now, we're going to do in dollars, right? So you can see your dollars doubling now, gets to that same number here. And we just put a 22% tax rate at the end of each day. What does that look like? And so let me unhide my magic work here. You can see now I've added some tax balance, the difference in percentage. See the tax balance, you can see it comes out below. You take a 22% rate off that $1 growth. Now all you have left is 78 cents. And that 78 cents is now what's going to double. And you pay tax on that. And that comes out to 95 cents instead of $2. So you're already half behind. You're already 50% behind. You can look at the column over here. You're already 52% behind just after 2 days of a 22% tax on this rice money. And you can see, look how many decimal points I had to eventually get to just so this didn't show 100%. The difference is stark when you're paying tax. Look at this, a 22% tax rate when she's doubling every day for 30 days. Look at the difference, $500 million or $250. More wealth than any of us could ever imagine, or enough money to take your spouse out to a nice dinner. That's the difference, the power. Isn't that stark? Look at, and let's bring up the visual. Look at this visual. Because of the scale again of the end of tax-free doubling, the red line, which is the taxed balance, doesn't even really get off the ground. Look at that. See, that's the power of tax. If you're paying tax each year on your account, you're not facing this because you're not getting the returns. And that's a fair criticism of what I've done so far. Well, it's only that stark because you're projecting 100% returns each period, each day here. And that's right. And I thought of that before hitting record. So let's move on. So now I wanted to say, okay, let's put this in the money. Let's just, get this grain of rice story out of here. Let's put us in the money. And instead of doubling each day, and now I've converted to years. So instead of doubling each year, let's just put a reasonable gain. And what I did here is I looked up the history of the S&P 500, and I just took the positive years, the most recent positive years. I didn't want to get into the power of loss, and the compounding power of loss is another video for another day. That really doesn't have much to do with income tax. So I just took out those negative years, and I just added the most recent 30 positive years here. And I just gave them $100,000 starting balance. By the way, I also estimate, I just kind of eyeballed the tax brackets throughout history for the last 30 years and took like what's kind of a median to low end income tax bracket. So that's the tax rate we're paying at. Because important thing to consider, when you get those 1099 divs or 1099s for the interest you've earned, it goes on to your taxable income. So it really just adds on to your last dollar. So if you're in the 22% tax bracket, remember that tax bracket video a couple times ago? Well, it's just going to be taxed at 22%. That's what's going to be done. It just adds on to the income. So that's what I did here. So we have a little bit of variation in the gains, and a little bit of variation on the tax rates. You with me? If not, rewind it, listen to it again. Moving on to my magic here. So now we have our balance of tax balance and the difference. And you can see it is as stark as the one before, but at the end of 30 years, and by the way, I know a lot of people in the financial planning business who use projections on the 30-year retirement, for example. At the end of 30 years, instead of $9.698 million, a person is left with $3.171 million, a 67% difference. The power of just paying tax on these real world S&P plus 500 gains each year results in a 2/3 difference in the balance of the account. Let's look at this chart. And here it is. Look at that. Let me get this a little, there we go. You can see blue line, the tax-free balance, red line, the tax balance. So if at the beginning in this year zero, you put $100,000 in an IRA or just a post-tax investment account and had 30 positive years of what I took, but paid tax on those gains each year. Again, this is just to illustrate the point, to entertain with the point, to inform you. But look at that gap. Look at that gap. What would this do for a family of 4 kids who are maybe preparing for retirement when mom and dad die, to inherit $8.3 million in year 29, let's say, that's the last one I can make pop up here, or to inherit $3 million. Both would be great. Don't get me wrong. Money's money. But between 4 kids, would you rather have $2.1 million or what did that, $700,000? That's a difference. It's a big difference in quality of life and things you have to worry about and not worry about for the rest of your life and probably the rest of your kids' lives if you handle it correctly. Now we've gotten into, tax, as I mentioned, IRAs. So a Roth IRA, if you had to put that on, this balance would also be tax-free when it's taken out. This balance as long as the step up in basis is preserved, this would be tax-free. So there's something to say for that on my IRA to regular old investment account example. But if you were able to do Roth with $100,000 versus just contributing $100,000 to a regular investment account, there's a big difference. That's life-changing money. That's family-changing money. And that is the power that tax has. When you pay tax each year, it just eats up your returns. It just eats it up. And by the way, know what I didn't put in this that would also eat up returns? Your advisor's fees. That eats away returns. But that's for another day. We're at an income tax boot camp. So we'll save those topics for another day. What do you want to hear more about? Let me know in the comments. Give me a subscribe. Give me a like. That helps the algorithm have other people find my videos. And I really appreciate the help getting this thing launched because I think I'm giving the good information here. Give me some feedback, good, bad, in between. I really would appreciate it. Other than that, stay safe, be kind to each other. Adios.